Low gross profit minus high OPEX equals negative EBITDA. Thanks, SoftBank. There's no x-axis on this chart. It's just kind of like I don't know, it's whatever timeline you want to prescribe to it. And so now SoftBank is the victim of massive memes. If you've been on Twitter, and if you go on Twitter and you punch in SoftBank WeWork, you'll basically see these people, and by these people, I mean SoftBank getting trolled because they're making fun of these slides. And everyone's making fun of these slides. You can kind of see here some of these different things, right? Basically, increase profit, reduce OPEX, and then, bam, money. And there's another, I took another kind of consolidated photo here, which helps to sum up some of the major takeaways. Low gross profit minus high OPEX equals negative EBITDA. Thanks, SoftBank. And now this is the improvement: increased gross profit, lower OPEX, and increased EBITDA. And then the bottom one is the hypothetical turnaround of there's their EBITDA, which is negative. And then now in the future, that's the turning point here where now we go up and to the right. The interesting thing is there's no x-axis on this chart. It's just kind of like I don't know, it's whatever timeline you want to prescribe to it. Now, to give Masa, who runs SoftBank and the Vision Fund, credit, okay, and to defend them, these slides are supporting materials that were presented in SoftBank's earning call. And so there's a lot of context that is spoken against each one of these slides, right? It's not just, this isn't their whole plan summed up very simply on these slides. So I think, that said, I think SoftBank, knowing how many investors or how many, not investors, portfolio companies, how many startups that they have met with and probably, ridiculed or provide harsh feedback to the founders or to the broker that was trying to raise money from SoftBank because they said, well, you just didn't do a good job presenting your materials or your information or making a good argument as to why we should invest. It's a double-edged sword, and clearly it's coming back to bite them because they should know, they should expect that if you're going into a public quarterly earnings call and these are the slides that you're projecting, yes, they make sense with the context of you talking to the slide. But this is 2019, and the slide taken out of context, which is literally what happens every single day in 2019, things are taken completely out of context, and then memes are made out of them. And so now SoftBank is the victim of massive memes. And honestly, they should have seen that coming. I mean, they're not idiots, clearly. They're not oversimplifying the WeWork situation. They're very smart investors. They're very smart operators. They have a very successful business called SoftBank in China. They also are a huge owner of T-Mobile. So when you look at their actual total return here, they break out all of the different holdings. They break out where their income is coming from between Sprint. They're a big owner of Sprint. Well, now these two things are merging together. Now, here's the interesting thing. Because SoftBank became a majority owner of WeWork, now WeWork's books and the money they're putting into WeWork now is showing up on their financials. And they put money into WeWork, not just from the Vision Fund, but from SoftBank, the corporate entity. And so it was really interesting how all of this had to come together and how they're having to present all this information in their quarterly earnings. For the rest of the Vision Fund doesn't necessarily have to say that we are an owner in this and we have to represent your financials. So yeah, these are the WeWork slides here. And then they had to cover the write-down, right? Now, here's the thing about WeWork. So they were doing about $1.7 billion in revenue, I believe. And they, I think, are currently valued. They're currently valued in the single digit billions of dollars. It's hard to say exactly where they're valued because it's basically it's basically SoftBank deciding what they're valued at. But let's look at a comparable. Let's look at Regus. Are you familiar? Regus has been doing office kind of co-work, co-sharing, desk sharing for years and years and years, long before WeWork. And this business, it's a public company, has been doing in 2018 did about 2.34 million euros in revenue, generated about 177 million euros in profit. So you could say it's about a couple $100 million in profit, about maybe $2.5 billion in revenue. And if we look at their market cap, they're valued at about $3.5 billion. So you say to yourself, okay, they have a less than 2x revenue multiple. They have a maybe like 17x EBITDA multiple. And then if you run those numbers on over to WeWork, and let's say you're generous, let's say you give WeWork a 2x revenue multiple, that puts them at what, $3.5 billion valuation. Maybe you give WeWork a 3x revenue multiple. Okay, now they're around $5 billion. That's the latest rumor. I originally had heard that WeWork was around $9 billion. Now I heard maybe it's down to $5 billion. But that would roughly give WeWork a 3x revenue multiple valuation. I guess they are growing a lot, so I think they have a much more aggressive growth than Regus. But I'd still say there's definitely a premium on WeWork, despite not being anywhere near profitable. But then you basically have to say to yourself, okay, finally, they're in the ballpark of being valued like a real estate company, which was what the problem was the whole time. They're being valued like a tech company when they were a real estate company. So now that veil has popped. They've dropped back down to earth. They're being valued kind of as basically like an ultra high growth real estate company. And now this is more realistic, right? You're saying, do I believe that they can keep up their growth? Do I believe that they can get control over their costs? And does that justify a premium of a real estate multiple compared to these other comparable businesses that are profitable but don't have as much growth? That is a much more realistic setting and landscape to be evaluating the WeWork investment decision versus where it was at about what, like $40 billion, something crazy. That I think is a great example of really transparency, the forcing function of being a listed company working and providing that transparency, letting the broader investment community make a decision as opposed to one or two ultra dominant shareholders or investors like WeWork, driving the valuation up and kind of arbitrarily doing so in the process. So it's kind of good to see this. It's a healthy process. Going back to my conversation from last week with Dara, the CEO of Uber, that doesn't mean, it certainly has dampened tech companies' valuations that are public and losing money. But it doesn't mean that a tech company like Uber, a platform company like Uber, rather, is astronomically away or astronomically valued much higher than what they should be valued, like what happened to WeWork, right? Uber is a platform company. They have legitimate demand and supply side network effects, not just in ride sharing, but also in Uber Eats and their other kind of other bets categories. And they're classified correctly. It's really then just a question of how much of a premium do you put on that high growth tech platform business type of company. For WeWork, the problem was they were being put in the completely wrong bucket of multiples and valuations. Now they're in a much more appropriate bucket. Hi, this is Alex from Winner Take All. Thanks for joining us. Hope you enjoyed the content. Feel free to leave a comment, ask us questions, and definitely make sure to join us on our next live stream.